With this stock hitting new 52-week highs and screaming strong buy, um, is Marvell Technology a genuinely undervalued AI powerhouse, or are retail traders about to walk straight into a brutal value trap?
Yeah, I mean, that is the defining tension right now. When a chart goes completely vertical, human psychology kind of just gets weaponized against the trader.
Right.
You have the fear of missing out going head to head with the fundamental reality that parabolic moves eventually exhaust their buyers.
Exactly. And we are going to tear into the actual mechanics of that exact tension today. But real quick, before we dive into the sources, if you are listening or watching right now, please hit that like button, subscribe to the YouTube channel, and it is absolutely compulsory that you leave your comments and feedback down below. Tell us if you are buying this breakout or waiting for the floor to fall out.
Definitely want to hear what you all think.
Yeah. So today's mission is unpacking a massive stack of real-time market quotes, financial reports, and analyst ratings from today, April 14th, 2026, all focused entirely on Marvell Technology, ticker symbol MRVL.
And just to set the baseline for you listening, this is a purely intellectual exploration of the source material. We are analyzing institutional behavior, dissecting financial statements, all that good stuff, but this is absolutely not financial advice, just a natural human debate about the data.
100%, not financial advice. So let's start with the immediate price action and the tape from today. Current price is sitting at $134.28.
Which is a massive move.
Oh, it's huge. That's a $5.79 move, up 4.51% today alone. And the 52-week range is just a crazy spread, from $48.09 all the way up to a brand new high hit earlier today of $133.20. And then it broke right past it to where we are
It
now.
really didn't even pause.
No, not at all. So we're looking at a $114.82 billion market cap. But, the raw price only tells half the story. The source material shows heavy institutional accumulation happening right in that $129 to $131 range, which kind of triggered this current breakout.
Right, that was the launch pad.
Yeah, and seeing institutional accumulation at $129 is like seeing the biggest whales in the ocean suddenly swarming one reef. I mean, there's something tasty there.
That's a great way to put it.
But I have to push back a little here. Looking at the volume, we are at 19.3 million shares traded today,
Yeah.
which is actually below the 30.2 million daily average.
Mm.
So with volume that low, I mean, is this breakout really as strong as it looks, or are we lacking conviction?
Well, what's fascinating here is that you really have to understand how institutional order flow operates. When massive funds decide to build a base in that $129 to $131 channel, they aren't just aggressively chasing the price upward.
Right, they don't want to spike their own entry point.
Exactly. They use algorithmic execution to passively absorb selling pressure. They basically sit on the bid and let the impatient money come to them.
Oh, wow. So
Yeah.
they just quietly vacuum up the shares.
Yeah. Once they've effectively absorbed all the willing sellers in that range, the supply completely dries up. And when supply evaporates, it takes a surprisingly small amount of buying volume to trigger a really violent move upward.
Huh.
So that lower volume on the breakout day isn't a lack of conviction at all. It's actually a signal of absolute supply exhaustion. The sellers simply ran out of shares.
But wait, doesn't that create a huge vulnerability for the retail trader who is just, logging into their account today? They see the AI narrative trending, they see the stock hitting $134, and they just blindly jump in.
Oh, absolutely. And that is exactly why retail traders often get trapped. They jump in only after the breakout, tracking the hype, right as those same institutions who bought at $129 might be looking to lock in some quick profits.
Okay, let's unpack this then. Because if institutions are quietly loading up on billions of dollars in stock, they must see something under the hood that justifies a $114 billion valuation.
They definitely do. The financials are really revealing here.
Yeah, looking at the income statement. For fiscal year 2026, annual revenue hit $8.195 billion. That is a 42% year-over-year surge.
Massive growth.
And net income was $2.67 billion, which, that is a massive rebound from a net loss in fiscal 2025. It's like a sports team going from last place in the league straight to winning the championship in a single season.
Yeah, that violent swing is really the hallmark of operating leverage in the semiconductor space.
Right.
Once you cover your massive fixed R&D costs, Almost every additional dollar of revenue flows right to the bottom line.
And you really see that in their margins. I mean, the gross margin is 51% GAAP, but a staggering 59.5% non-GAAP.
Which is incredible.
Yeah. And for Q4 2026 specifically, they posted record quarterly revenue of $2.219 billion, up 22% year over year, with an EPS of 80 cents that beat expectations.
They clearly have immense pricing power with those hyperscale clients.
But here's where I get a little stuck looking at the cash flow and balance sheet.
Right.
They returned $2.245 billion to shareholders via buybacks and dividends.
Right.
The dividend is tiny, like 6 cents a share, and the ex-div date just passed on April 10th. But over $2 billion in buybacks. I mean, is returning that much cash a sign of incredible strength? Or does it mean management just lacks better R&D ideas for that money?
Well, from a capital markets perspective, executing massive buybacks when you are in the middle of an AI hardware race, it sends a really strong message. It signals that management's internal modeling makes the stock look cheap to them.
So it's basically them saying, we believe in our own valuation.
Exactly. It shows internal confidence, and it provides a structural floor for the stock.
Okay, well, here's where it gets really interesting. Because if the fundamentals look fantastic, what is the chart telling us about the actual timing of jumping into this stock right now?
The technicals are definitely flashing some warnings.
Yeah, I mean, the trend is strongly bullish, obviously trading above all the major moving averages. We've got support found at $128.49, which was the previous close, and a really solid base down at $119 from early April.
Right, the $119 level is crucial.
But right now, the stock is currently battling this massive psychological resistance at $135, and the next major target isn't until $156.
Yeah.
And looking at the momentum oscillators, the RSI, the Relative Strength Index, is approaching heavily overbought levels above 70. I mean, it's like a sports car redlining on the highway.
That's a good analogy.
It's moving incredibly fast, but the engine might be about to overheat. So is this short-term technical strength actually a glaring weakness for anyone trying to buy in today?
It introduces significant short-term weakness and risk, absolutely. I mean, momentum dynamics in a hyper-aggressive AI phase can be tricky. A stock can stay overbought for a while.
Right.
But buying right at heavy resistance, like $135 when the RSI is over 70, you're basically absorbing all the technical risk. If it rejects there, you could instantly see it slide back to that $128 support.
Which is just punishing for a new buyer.
Exactly.
So if the chart is basically redlining, how are analysts valuing it? Because this leads us perfectly into the big debate from the sources. Is this stock truly undervalued, or is it just a value trap disguised by all this AI hype?
Well, the analyst community is overwhelmingly bullish.
Oh, it's crazy. The consensus is literally 78 buy ratings, 19 holds, and exactly 1 sell rating.
Just one.
Right. And the high price target is out at $164. In fact, B. Riley Securities just upgraded their target yesterday, April 13, from $135 to $156.
So they see plenty of upside.
But then you look at the valuation. The forward PE is sitting at 42.77.
Which is steep.
Very steep. Buying a stock with a 42.77 forward PE is like paying premium scalper prices for a concert ticket before you even know if the band is going to play their hits.
Yeah.
The only way they are defending that multiple is this projected 30% revenue growth for FY 2027. So are these 78 analysts just rubber stamping the AI hype, or is this 30% growth actually real?
Well, if we connect this to the bigger picture, it really defines the undervalued versus trapped debate. If the company executes flawlessly and hits that 30% growth, the forward earnings swell, the multiple compresses, and suddenly today's price is genuinely undervalued.
Right.
But if they miss, if growth comes in light, a 42.77 PE instantly becomes a vicious value trap, and the market will reprice it violently.
Which means growth needs to be totally flawless to justify this price.
Exactly.
So let's map out the battlefield here. What is the bull case that makes them think they can hit those numbers? And what are the worst case downside risks?
The bull case leans heavily on their dominance in data center and AI custom processors, their XPU business.
Right, the custom silicon.
Yeah. They are seeing unprecedented record demand from the hyperscalers, Amazon, Google, Meta.
Got big guys.
Exactly. Plus, they have some massive recent catalysts. They secure the Nvidia partnership, and they've made really strategic networking acquisitions recently.
Oh, right. Celestial AI and XCon Technologies.
Yeah, which positions them to completely own the optical interconnect bottleneck in these massive data centers.
Okay, but what about the bear case? Because I noticed in the sources they recently divested their automotive Ethernet business.
They did?
Which I mean, that hurts their segment diversification,
It,
right? They are basically putting all their eggs in one basket.
it is a massive concentration of risk.
And that leads to my biggest concern with the downside risk. An over-reliance on just a few hyperscale clients. I mean, if you rely entirely on Amazon, Google, and Meta, if one of those hyperscalers sneezes, does Marvell catch a cold?
Oh, they catch the flu.
Yeah.
Capital expenditure in tech is cyclical. Right now, it's an arms race. But if Amazon or Meta decides to slash their hardware orders next year, Marvell's 30% growth projection just completely evaporates.
Wow. Okay, so mapping that to the chart, what does the worst case look like?
The worst-case continuation lower is that the stock fails at $135 resistance, retail panics, and it falls all the way back down to test that $119 support base.
And the best case?
The best-case breakout is that the institutional buying pressure pushes it cleanly through $135, turning it into support, and we run toward that $156 target.
So what does this all mean for the timeline? Because if a listener is evaluating all these sources, they need to know what to watch next.
Short term, meaning the next few weeks, all eyes had to be on the upcoming May 28, 2026 earnings report.
Right, May 28th.
A sustained breakout above $133 or $135 leading into that date indicates the market expects immediate upside.
But is that May 28 earnings report a make or break moment? Because looking at the long-term perspective for fiscal year 2028, management has this highly ambitious target of hitting $15 billion in annual revenue.
Driven entirely by AI infrastructure.
Right. So could this single earnings report instantly invalidate that massive $15 billion dream?
This raises an important question about execution risk. Bridging the gap from today's $8.19 billion revenue to tomorrow's $15 billion target requires perfection.
Yeah.
One slightly soft quarter on May 28 might not break the long-term trend,
Yeah.
but at a 42 multiple, they have zero margin for error. Any weakness in institutional capital will completely re-rate the stock.
Wow. Okay, so to summarize this incredible deep dive, Marvell has pulled off this staggering financial turnaround, right? They've got deeply bullish momentum. They are dominating the AI networking space.
Definitely.
But that is firmly balanced against technicals that are practically redlining, heavy resistance, and the massive risk of relying on just a few tech giants for their survival.
It's a high wire act for sure.
It really is. So, to leave you with a final thought to chew on today, if Marvell is the ultimate shovels and pickaxes play of the AI gold rush, what happens to their $15 billion dream if the big tech hyperscalers suddenly decide they've bought enough shovels?
That is the multi-billion-dollar question.
Absolutely. Thank you for joining us as we dug through the data today. Remember to hit subscribe, drop your thoughts in the comments, and keep in mind this was a deep dive into the sources, not financial advice. We will catch you on the next deep dive.